Okay, good.
Yes, sir.
So now our prime, you know, responsibility is now to record this. And remember, revenue recognition and expense recognition principle must hold. So on July 1st, your first payment of interest is here. So you issued on 1st January and you have to pay interest on July 1st. So on July 1st, how much you pay? You promise to pay coupon. So coupon payment is 4500. So cash is 44. Cash decrease, credit. Interest expense always debited. Interest expenses 4164. This equation is not balanced. Why? Because there is also premium. Premium amortized 36336. Now the equation is balanced or entry is balanced. So you see interest expense, premium, and cash. Cash is basically the interest payment because payment is always on cash because promised coupon is promised interest payments. All right. Entries are the same. Just if you know the concept, you can develop it. In case of when you amortize the discount will be amortization of discount will be written on credit side. Amortization of the premium will be written on debit side. Right? So interest payments are smooth 4500 while interest expense are decreasing. So in case of premium, interest expense always less than interest payments. Whereas the bond value issued at 104,100, it will go down to its maturity value or face value 100,000. So it means this shaded area of premium we must amortize, we must decrease it with respect to every interest payment. So 5 year means 10 payments of interest. Okay, so that's all for the issuance of premium. And what about the last one? This entry. So if we talk about this entry on 1st of January, sorry, because this expense belonged to 2014, but the payment is on 2015. So on the end of 2014, December 31st, what will be the entry? Cash decrease? No, we will pay cash the next day on 1st of Jan 2015. But this expense belongs to 2014. So create liability. So here the interest payable 4500. The same is here, which is interest expense, which is 4151, and premium 349. Just instead of writing cash, because cash is not paid on 31st of December, cash is paid on 1st of July next month, next year. Since the whole year interest payment, this the both belongs to 2014. All right. So we need to fulfill the revenue and expense recognition principle. All right. Now that's all for bond the treatment of and recording of bonds issued at premium. All right. Now let's talk about the last part of our balance sheet, which is owner's equity. So first of all, owner's equity, we are up till now we have discussed the accounting treatment with respect to corporations. So what are the corporations? So we talked about that. Corporations are run by different authority, owned by different authority. So the advantage of corporations are you can raise more capital than proprietorship and partnership. It has a continuous life cycle. It means owners can die, but company cannot die. Why? Because you can transfer the ownership without changing the name of the company. Plus, transferring of ownership is very easy. You just sold your share to somebody else, and it has limited liability. Disadvantage is that those who run the company they are managers, and those who own the company they are shareholders. So there is a separation of duties because management want to work for their own benefit, not for the benefit of ownership. So we call this agency problem. Plus there is a dual taxation because in the eyes of company, sorry, in the eyes of law, company is like an entity, like a person. When company earn, it is taxed. When company pay to its owners, owners income increases, owners are again taxed. Plus the regulation is huge when you set up corporation. So what are the hierarchy here? So first of all, the owners they elect board of directors. Board of directors elect the CEO, who is responsible for guiding the direction of the company, and then he elect the presidents of like every department: sales, manufacturing, finance, human resource, right, and secretary who basically manages all the affairs of CEO. And then they individually hold their own responsibility, but the CFO responsibility not only just find out where we can find out money, how we manage the funds, but also to control the funds. So under CFO there must be two person. One is called finance officer and one is called accounting officer. So we will be here because we are learning principles of accounting. We will be here, not here. Here we will be using financial management course or financial introduction to finance or financial management, corporate finance, this kind of stuff. We're gonna be here, but here we will be recording the expenses, recording the books, maintaining the books. It's like that, right? So shareholders' right, of course, they have a right to vote according to which kind of board of directors, who should be the board of directors. They have a right to receive dividend. Liquidation means they must have a right to receive some kind of proportionate shares of assets remaining if company is liquidated, but after paying all its liabilities. And then preemptive right, which means right to maintain one's proportionate ownership in the corporation. If new shares are issued to the existing shareholder, right? If your ownership is 5%, you will be given among the new share only 5%. You cannot receive more than 5% because your ownership is only 5%. So you will be given the share from the new issuance of the shares only 5%. So this is called preemptive right, so that your ownership in the company is not threatened. Now here comes the real deal for you guys because we are recording, we are accountants, and we need to record the transactions, understand the transaction, which part belongs to which part of the shareholder equity. So shareholder equity consists of two things: retained earning and paid in capital. All right. So what is paid in capital? Paid in capital, which means when companies are issued, when companies are established, they were given some authority. We call this authorized capital, which means company cannot issue. For example, authorized capital is 10 million, or you can say that 100 million shares. So it means over the life of the company cannot issue more than 100 million shares, right? So that doesn't mean that company have the backup of also backup cash against this share. This is just the authorized capital. You are allowed to issue shares here, but company issued only 500,000 shares. So this is called paid in. So how much company can further Raise the capital 95 million because point 0.5, okay, 99.5 million because 5.5 million shares already issued. Issued means you receive the cash against those shares paid in. All right. So also call this contributed capital, amount of equity the shareholder has contributed, which include stocks and any additional paid in capital. What do we mean by additional paid in capital? Like we just received more money from our bonds on premium. So premium is normally recorded on bonds, but premium if your share is $10 and you issued it for $30, right? So on the top you receive 20 extra. So this is the premium, but we, in case of shareholder equity, we call it additional paid in capital. All right, we don't use the word premium, although this is a premium, but in order to segregate premium on bonds and premium on stocks, we just segregate it with the names. Premium on bond is called premium, and premium on stocks is called additional paid in capital. All right, so additional paid in capital means that you receive some extra amount, a premium on issued on issuance of shares. And what do we mean by retained earning? We have talked about a number of times. Retained earnings, which means these are the earnings that we retain in the business. So they increases when your net income increases and you do not pay the dividend. When you pay dividend, earning retained earning decreases, right? Reduced by the dividend declared. All right, so this is a value of or the sorry, this is the figure of or picture of a stock. So you see, common stock $0.5, $0.05 par value, which means the face value of this share is 0.05. This is the company name, this is the name of the shareholder, and the number of shares here as well. So this is one. But right now you cannot find the one share. These are issued on bundles for minimum, for example, 500 bundles. So the value of this stock would be a bundle of 500 shares. All right. So 500 multiplied by 0.05. So the value of par value of this 500 option is going to be $25. All right. Okay.